For decades, the global financial system has operated on a simple principle: debt. Modern economies run on borrowed money. Governments borrow, corporations borrow, banks borrow, even households borrow. Debt fuels economic growth. When more money enters the system, spending increases, investment rises, and economies expand. But there's a hidden consequence to this structure, because every loan creates new money, and every new dollar eventually requires repayment with interest, which means the system constantly requires more debt to sustain itself. Over time, this creates an enormous expansion of the global money supply. In the early 1970s, global debt was relatively small compared to the size of the world economy. But since then, something extraordinary has happened. Debt has exploded. Today, global debt has reached over $300 trillion. Governments across the world owe massive amounts of money. The United States alone carries tens of trillions in national debt. Many European countries operate with debt levels that would have been considered impossible decades ago. Japan has one of the highest debt levels in modern history. And yet the system continues expanding. Why? Because if borrowing suddenly stopped, the entire economic structure could slow dramatically. Growth would stall. Markets could collapse. Banks could face enormous pressure. This creates a difficult situation for policymakers. Debt has become deeply embedded in the financial system. But as debt levels grow larger and larger, maintaining stability becomes more difficult. Interest rates must be carefully managed. Economic shocks must be contained. And central banks often step in to stabilize markets. But the question many economists now ask is simple. Can this system continue forever? Or will the global financial structure eventually require a major adjustment, a reset? Because throughout history, monetary systems rarely remain unchanged indefinitely. They evolve, they transform, and sometimes they break. If you study financial history carefully, one pattern appears again and again. Monetary systems do not last forever. They may appear stable for decades, sometimes even for a century. But eventually, the pressures inside the system begin to build. Debt grows, currencies lose purchasing power, financial imbalances accumulate, and eventually, the structure must change. Throughout history, many monetary systems have followed this cycle. In ancient Rome, the Roman currency originally contained high levels of precious metal. Silver coins, known as the denarius, circulated widely across the empire. But over time, Roman emperors began reducing the silver content of these coins. More coins could be produced using less silver. At first, the public barely noticed, but as the process continued, the currency slowly lost its value. Prices began rising, confidence weakened, and over time, the Roman monetary system deteriorated. Centuries later, similar patterns appeared again in Europe. Governments frequently debased their currencies in order to finance wars and public spending. Kings and rulers reduced the precious metal content of coins. More money entered circulation. But the purchasing power of that money gradually declined. This pattern repeated throughout many different societies because monetary systems are deeply connected to political decisions. And governments often face strong incentives to expand the money supply, especially during times of crisis, wars, economic collapses, financial emergencies. When governments need resources quickly, expanding the money supply can appear easier than raising taxes or cutting spending. But this approach often creates long-term consequences. As the money supply grows faster than economic output, inflation tends to rise. And when inflation persists for long enough, confidence in the currency may weaken. Eventually, the system must adjust, sometimes gradually, sometimes suddenly. And these adjustments often take the form of a monetary reset. One of the most important monetary resets in modern history occurred in 1971. For decades after the Second World War, the global financial system operated under the Bretton Woods Agreement. Under this system, most major currencies were linked to the United States dollar. The dollar itself was tied to gold. Foreign governments could exchange dollars for gold at a fixed rate of $35 per ounce. The system provided stability, but it also imposed limits, because if the United States printed too many dollars, foreign governments could demand gold in exchange. Over time, the United States began running large budget deficits. Government spending expanded. The Vietnam War placed enormous financial pressure on the American economy. And gradually, more dollars were circulating around the world than the United States could realistically back with gold. Foreign governments began requesting gold. America's gold reserves started shrinking. The system was becoming unstable. Then, in August of 1971, President Richard Nixon made a decision that would change the financial world forever. The United States would suspend the convertibility of dollars into gold. The gold window was closed. This decision effectively ended the Bretton Woods system. From that moment forward, the global financial system became based entirely on fiat currencies. Money backed not by gold, but by government authority. This was a major reset of the global monetary order, and it reshaped international finance for the next 50 years. But today, many economists and analysts believe that another transformation could eventually occur. because the financial pressures building inside the current system are enormous. One of the largest pressures on the modern financial system is global debt. Debt allows economies to expand quickly, but when debt levels grow too large, they can create structural challenges. Governments must devote increasing portions of their budgets to interest payments. Central banks must carefully manage interest rates, and financial markets become sensitive to changes in borrowing costs. Today, global debt has reached levels that would have been difficult to imagine in earlier decades. Governments across the world carry massive debt obligations. Corporations have borrowed heavily. Households rely on mortgages, credit, and consumer loans. This interconnected structure means that changes in interest rates can ripple across the entire financial system. If borrowing costs rise too quickly, debt servicing becomes more difficult. Economic growth may slow. Financial markets may experience volatility. This is why central banks now play such an important role. They attempt to balance inflation control with financial stability. But the challenge grows more complex as debt levels increase, which leads many economists to ask an important question. If debt continues expanding faster than economic output, can the current monetary system remain stable indefinitely, or will it eventually require another adjustment? The term monetary reset can mean different things depending on the context. In some cases, it may involve a restructuring of debt. Governments might renegotiate obligations or change financial rules. In other cases, a reset could involve changes to the global reserve currency system. New economic powers could influence international finance in different ways. Some analysts believe the global financial system may gradually move toward a multi-currency structure, where several major currencies share global influence. Others speculate about the potential role of digital currencies issued by central banks. And still others explore the implications of decentralized technologies, such as Bitcoin. Each of these possibilities represents a different potential direction for the global financial system. But the key point remains the same. Monetary systems evolve, they change as economic conditions shift and new technologies emerge. The financial structure that dominates one century may not look the same in the next. Predicting the future of money is extremely difficult. Financial systems are influenced by politics, technology, economics, and human behavior. But history offers one important lesson. Periods of major financial transformation often follow long periods of stability. The global monetary system we use today has existed for only a few decades. In historical terms, that is not very long. And as new economic forces emerge around the world, the structure of global finance may continue evolving. Whether that evolution takes the form of gradual reform or sudden transformation remains uncertain. But understanding the foundations of the current system helps us recognize the forces shaping its future, because the story of money is never static. It is constantly changing. And the next chapter of that story may already be unfolding.